Welcome to Breaking Banks.
Welcome to this week's episode of Breaking Chains Crypto, a brand new podcast hosted by the team that brought you the Yield app. In this first episode with Rhys, Lucas Kiely, along with Ajit Tripathi, we discuss the current landscape and share reasons why we think the battle of the L2s is only just getting started. And ChatGPT is in the news. While incredibly useful, we think it has striking similarities to being a Big Four consultant. And why has South Korea shown evidence that it's a fertile ground for producing some notable degens? Find out on this week's Breaking Chains Crypto.
Hi guys, welcome to the first edition of the Breaking Chains podcast. And this week, as we will have every week, we have myself, Lucas, Rhys, and Ajit. And so welcome to the show, guys. And I guess this is going to be the first of many. So Rhys, back in Bangkok. It's been a while.
It's been a while, mate. It's been a while. It's great to be back here, though.
It's great to be back here. Great to see you, Lucas and Rhys.
Ajit, where in the world are you?
I'm in Dubai now. It's the crypto Miami, crypto capital of the East, apparently. And
another Mecca in the Middle East.
Well, yeah, quite a few luminaries are moving here, as you're aware. There was some rumors of Caroline moving here. That didn't happen, thankfully. But there is quite a nice crypto.
I heard she's single now, mate.
I think you missed a flight, didn't she?
Yeah, maybe.
Yeah, that information is not useful to me because I'm married, but good for her.
Well, you're living the dream down there, mate. So we're just slumming it in Bangkok as always. So it's been an interesting time this past 12 months in crypto for sure. I mean, we've seen it all and done it all. And here we are at the other side with a sort of a rally into the start of the year, which has got a lot of people excited. So it seemed like a good time to start this podcast. And so, funny things have happened, right? We've seen, FTX go from the greatest minds in crypto to being, proven to be complete frauds. We've obviously seen the blow up of Celsius, BlockFi, Three Arrows, Terra Luna, et cetera, and the list keeps running.
There was obviously like a chain of events that caused a lot of people to become exposed to what they're actually carrying out. I think yourself and I had these discussions around what risk management looks in the space and where trust was being placed. And I think even the parties where we assume to have the highest level of trust, FTX and Alameda, etc., were arguably the biggest market makers in this business, turned out to also not be adhering to like the kind of risk we would expect from a developed industry. Hard to say, I guess from 2017 to now, we have more institutional capital, but it's not being ran like institutional capital. I think that it's a good wake-up call, I think, for the expectations we have around how people behave in this ecosystem. So, but yeah, I guess we'll see this continue to wash out in 2023, but it's certainly an eventful 2022. So the ultimate tide is out year, I'll say, for 2022.
What about you, Ajit? Do you think we look back on 2022 and the lessons we're going to learn going forward, or do you think we'll just make the same mistakes over?
I don't think anyone ever learns anything in markets, particularly. Right? I think the collective mass of our learnings is called regulation. Otherwise, market participants, there's always a new flow of new people or people who have goldfish memory. And as soon as, the super cycle starts again, people forget all the lessons of Terra Luna and everything. In fact, you see, Bonk and the dog.
Mate, all of that's stored on chain. We're never going to forget that. It's all going to be stored on chain, mate. It's going to be.
Did you say the Zupa cycle? I thought I heard you say the Zupa cycle.
From Mario Kart.
The super.
Oh, that was the
cycle,
Koopas,
right?
wasn't it?
Oh, the Koopa tree.
No, the fun thing is I met Suzu in Crypto Bahamas, right? And I asked him if he was doing PsyOps, and he said, no, I'm serious about it. And he was serious about it. And I think as soon as, and then somebody tried to sell me a private jet in the Bahamas, and I looked at myself and I said, man, I drive a Honda. So and that was the day.
But you
I
drive
sold
an
a lot of
NSX, mate. You're not driving a Civic, are you?
I'm driving an SUV, so the market is not so bad, right? And we haven't got to the used Civic levels yet.
One more drawdown, Ajit. One more drawdown.
So funny story about Suzu. I used to work with Suzu at Credit Suisse back in the days. He used to work for a guy called Harj and Dave Best on the Delta One desk at Credit Suisse. And I remember him and Kyle working away, and I sat on exotic trading, and they left. They came in and resigned one day and set up their emerging market currency arbitrage fund, and did a whip around Hong Kong and Singapore, and didn't work out too well. And
it did work out. Okay, I see you. It didn't work out back in the day when they were doing the currency arbitrage stuff.
No, exactly right. And so, like many people in funds or set up funds or businesses in crypto who come from TradFi, a lot of it's like, I've got some lessons learned from this, and a lot of the lessons that I learned being in CS and seeing these guys and what they're about, and then coming to us to raise money, etc., was just like, what, this is not where we want to be. So I mean, we didn't do much, or we didn't do anything with them. It's, I think the thing for me is finance, whether it's crypto or traditional finance, is a people business, right? And people businesses are about trust, and whether you believe that person with your capital is going to do the right thing with it. And that's about character, right? It's about what happens when the shit hits the fan. How do you react to it? And we can go through a plethora of stories around how managers have managed the FTX fallout and how they've tried to trade out of it, and some of it has been quite shocking, right? So really, that's stunning. You would think that.
So funny part is I met Suzu in Dubai 2 weeks ago, and I asked him some of these questions, and maybe we'll try and invite him to one of our shows. So I think first of all, crypto is slightly different from some of the other more mature markets because there are no hedging instruments, right? I mean, there is a very thin options market in crypto. There's a lot of liquidity on perps, but you don't really have some of the sophistication of risk management, or even at the instrument level or in terms of systems, right? So you might have 18 monitors to trade, but you're not really looking at any of the processes, ops, or anything that you might see if you're trading at a trading floor at Goldman, right?
No, I would disagree with that. I would actually disagree with that. And the reason why I would disagree with that is you can buy portfolio management systems, be it Infusion, be it Elwood from Brevin Howard. You can get Numerics, etc. And they all have the full risk suite, the full vol surfaces. You could get Synoption from the guy, what's his name? Anshul Jain, who used to run FX options, FX at JP Morgan, right? And you see this stuff, right? And Rhys and I have gone through all this stuff and seen all the tooling that exists for options and option market making and option pricing and etc. The problem, right? The real problem is this, right? Is the ISDA for bilateral agreements, or standard ISDA, has only just come out, I think, in the last week, right? So I saw an ISDA come out last week. Mm-hmm. Everything is bilateral, and in crypto, right, you're dealing in bearer instruments, right? So when you're dealing in bearer instruments, how do you get institutions to come and trade with you when regulated institutions are capital constrained due to Basel III, so they have to play on the CME or futures? You've got cash settled or physical like Bitcoin, etc. And let's say I want to trade with Goldman Sachs. I've got physical, they've got synthetic. I want to sell a call option to Goldman, and I want to give them my collateral as Bitcoin, but they can't take it. So then I have to give that to, let's say, Anchorage, which is partly owned by Goldman. Anchorage holds it there. Then Goldman loans me money, cash, against that collateral, and then I give the money back to Goldman as margin. It's just impossible to do. And so you remove the key liquidity providers from TradFi from the space. It doesn't mean the tooling's not there or the pricing mechanisms there. You look at someone like Orbit or QCP or some of these other guys. They're like all very advanced experienced options traders, and it doesn't matter what you're trading the option on, you've still got the same Greeks, and depending on the way that asset price moves.
But where are these option markets, right? I mean, most of this stuff is bilateral because when I try to trade options on Binance, I mean, there are very few options on some of the more illiquid tokens,
but
right?
FX markets
which are the
still
most
bilateral
inefficient
OTC,
markets,
right?
and there is a lot of money to be made.
But if you look at just basic
in most
FX, it's
currencies,
bilateral
that's
OTC,
true.
right? So if you've just got bilateral OTC, it's no different than that. The problem is there's just not enough players, right? And ultimately, let's say that I've got, you're dealing in an 80-vol asset class, and you sit there and say, well, I'm just going to run deltas against it. Well, you're going to take a lot of the vol in crypto is actually quite high because you just have moments of vol.
Yeah, I mean, one of the things not all of our audience is going to be very, come from the same experience as us. One of the things is most of Suzu and 3AC's troubles are essentially with their counterparties. So, there is not they might have made some representations or sent some letters to their counterparties to borrow, which may not be entirely accurate. But that's something they can resolve with their counterparties, because unlike Gemini, there is no retail money involved here, right? I mean, as far as I'm aware, at least not directly. So I think that's kind of a mitigating factor for Three Arrows, as long as they trilaterally, essentially settle their disputes with their counterparties, they're in a good shape.
But they're not going to. I can guarantee you, there's no one in their right mind going to enter into a new bilateral with Suzu or Carl Davis anytime soon, right? Because ultimately, your risk reward for that outcome is, if something goes wrong, it's very easy to say, well, why would you do that? Like, why did you do that in the first place, given the history? Like, if we look at the history of managers or people we've done DD on, right? And we look at people and say, oh, this guy's really good. This manager's got great performance. These guys have done amazingly well. You do a basic background check on some of the key players in this industry, or some of the key founders, right? And you say, okay, what's your background? Oh, you've got an SEC sanction for fraud and embezzlement. Oh, you've got an SEC sanction for market timing. Or you've got liens over your assets.
Do they look at all this stuff in crypto?
Yeah, it all exists, right? And you can't.
I don't know if crypto markets are at that level of maturity, right? So we might be expecting a little bit of a higher. I think we might be talking about a slightly higher end of institutions than, I think, like typical crypto funds or family offices or crypto hedge funds or liquid funds that are typically.
But what's your point, right?
This is not necessarily my point is, this isn't necessarily the Wall Street, and some of the ideas, and Wall Street also is quite forgiving, right? So LTCM guys came back and started another fund. I mean, we have 0.72, which is running really well. So I think there are
0.72 was just a family office now, right? It's not like it's a hedge fund again. It's just a family office.
Most hedge funds are family offices now, right? Because they are trying to avoid regulatory reporting requirements. Even Archegos was a family office.
That's true.
No one particularly likes to be regulated. So, so I think I genuinely believe Wall Street is very forgiving, and crypto Wall Street is even more forgiving. So it's not entirely inconceivable that there will be some counterparties that are willing to take a risk. And that's kind of where I think that's why they're starting this GTX exchange, which I think a lot of Twitter folks made a lot of fun of, which will essentially trade, claims on FTX, right? Tokenized claims on FTX. So that's a pretty interesting idea there.
Ajit, do you think it's now, like, since the FTX stuff came out and Sam was involved with retail money, Suzu and Kyle have come to the forefront because they're essentially the cleanest dirty shirt in the laundry now, right? Because you have that's what it is, right? You have Do-Kwon, retail money, Sam, a lot of retail money, institutional
Celsius,
money,
retail money.
Yeah, Tom Brady money. You don't want that money. You don't want that stuff, man. You don't want Tom Brady's money.
Yeah, and it kept getting darker and darker, right? Like it's like Harry Potter. You start with the first movie, and it's kind of nice and fun, and by the time you get to the end, you have outright. You have a polycule, you have outright fraud and theft.
That's exactly right, man. Yeah, and now you have Sue and Kyle go, well, at least we didn't defraud retail. We can probably take a shot, right? And that this is they're starting their character arc, right? Is that this is our prime opportunity? That's where I saw it coming from. They've got now we are the cleanest dirty shirt. We might as well take a shot, and they just reemerged. On crypto Twitter and started their PR roadmap for GTX, right?
And there are so many others out there, right? And we don't even know. I mean, and there were founders that started dying at the bottom of the market. I think, it's not even clear who's actually dead, but there were 2 or 3 folks who were, without mentioning anyone in case they're actually dead, who were declared dead or lost at the bottom of the collapse.
I know what's
So
absolutely dead,
else,
and this isn't going to rise from the depths like Lazarus, right? Is going to be Terra Luna. That's absolutely dead in the water.
I think the sunset.
Really?
Sunset.
Absolutely.
The token price, have you been watching the token price?
Oh, the classic. I think I've still got
yeah.
some 3x levered on what I bought at like 0.000001 or something. Are you telling me I'm up like 10,000%? Oh dear, no. I think for me, 2022 is really, really simple. It just shows that you can't let the children manage the money anymore. And I think we started to see, as the institutional big players entered the game, simple players who started out as crypto native were just getting completely destroyed. Let's take a very, very classic case of poor maths, right? Terra Luna modeling, stress testing. I don't know if you saw the stress testing paper on Terra Luna, but that stuff was just like, that came from Harvard, like really? And you could just pick holes in the math instantly, and no one checked it because it came from this guy. He's at Harvard, and this is great. And I think when Rhys and I modeled it
at Stanford.
When Rhys and I modeled it, we were like, "You what? No, this was last November 21." We learned that. What was your liquidity threshold of Terra Luna before you thought it would crash completely?
10%.
10% or something like that. It was just 10%. Like we couldn't get away from it. It was like, really?
10% of UST removed from Anchor would collapse it.
Yeah. And we were like, why would you touch that? And I think the tough thing for us is you can't go out on crypto Twitter and say and just be a hater, right? You just better just to shut up and say nothing and trade accordingly. But what was happening was like the big players would come into the space, be it the Citadels, be it the other big market makers or the big hedge funds, and they would just point a gun at the sheer lack of depth and liquidity in the market and say, okay, we can move this for $1 billion or we can move this for $500 million. And the risk reward is perfect. And it's amazing. Like if you see, the rally in Bitcoin at the start of the year, what happened? It was the start of the Martin Luther King weekend. US market closed 4 p.m. and all of a sudden there's this big move in BTC and the market starts to go and then it just gets a massive short squeeze and it's pushed all the way through 20K and everyone's like, oh, it's the start of the bull run. It's like, no, there's literally zero liquidity for the next 3 days. And they're just picking out all the stops and going to just force it higher and higher.
Did you notice that the subsequent rally was also Friday?
Yeah.
Same play.
And then in that time, you take someone like Coinbase stock is up nearly 100% as of Friday close in a week. I'm like, hold on, what's going on here? I mean, it's like GameStop all over again, right? It's just, you've got to realize that the crypto market itself is so manipulated. And I just don't understand, if I was a regulator, it's the one thing I'd want to clamp down on is the market manipulation in crypto.
And that's, but it's structural, right? If you, market making, exchange, custody, and venture, they're all sitting in the same firms under the same umbrella. There is no segregation of any sort. There are no Chinese walls between these things. There are no controls. So it's there are, it's like the securities market from the 1920s or something. I don't know, the pre-1934 Act, and a lot of rules after that. So unless there is kind of segregation across these things, at least custody and exchange and market making, you're always going to have very opaque, unpredictable markets, and it's very, very hard to short anything in this market, right? Because it's so easy to liquidate anyone.
Absolutely.
And it's only been made worse, right? Because we had all the market maker money was obviously on FTX, right? And that some got out, but not a lot of it. So we're just dealing on very thin markets. Even, before all this fallout happened, it was really FTX was the driver of volume because it's arguably it was the best place functionally to trade. I guess from a top level anyway. I don't think anyone was aware of the old God mode that Alameda had access to. It would have been nice to have that setting turned on my account.
Yeah.
But even then, the books were thin in specific assets, but now it's very, very thin.
So I was going to say other things that have kind of changed going into 23 is ChatGPT and OpenAI. I mean, we've got thoughts on that. I've got some big thoughts on that.
And so. ZK. So you know how the venture business runs on memes, and so the three biggest things right now are OpenAI, and everyone is really excited about ChatGPT. And there were a whole bunch of Web3 VCs that I'm aware of who were pivoting to AI, and there was quite a bit of a Twitter joke going around about how do we who is Vitalik pivoting to AI or something. So that's one. The other is ZK, zero knowledge, and most people have zero knowledge about zero knowledge. I'm probably one of them. But now with ZK rollups going live,
makes a mockery of KYC, zero knowledge.
Depends on how you use it, right? So
NKYC, no knowledge, no knowledge of your customer.
But I think Ethereum scaling has pushed zero knowledge research forward by at least 2-3 years. So let's see, right? I mean, Q1 we'll have a year full of ZK rollups going live.
So I had a bit of fun.
The privacy things going live.
So I had a bit of fun with ChatGPT, and I decided to see, okay, how good is it at, it's written by geeks for geeks at the moment, but ultimately, what if it was a bit like Bitcoin, really? What if I asked it to, so I asked it to do something for me. I said, can you make an interpretive argument about the 13th century poem Fowls in the Frith, which is a 5-line poem written in the 13th century. And the text is really simple. It says, fowls in the frith, the fishes in the flood, and a mon wax wad, such sorrow I walk with for best of bone and blood. And that's the poem. So I asked ChatGPT about this, and it said, Fowls in the Frith is a 13th century Middle English poem that is believed to have been written by an anonymous author. The poem is a humorous and satirical work that centers around the theme of the relationship between the humans and nature. Poem takes the form of a dialogue between a group of birds who are discussing the arrival of a group of hunters in the forest. But no, it's not.
So
that's a 5-line poem.
And
it's just gone off on a tangent.
Oh man. So ChatGPT is like a consultant, and I've been a consultant at PwC, right? So I mean, it sounds like it knows what they're talking about, and ChatGPT is very good at that. But it may not necessarily know what ChatGPT is talking about. So it's a bit like PwC and McKinsey over there. With due apologies to my friends. One of the questions I really wanted to ask ChatGPT was, "Sir, when token?" And unfortunately, there is no token, and they're starting to charge. I was hoping I would get an airdrop for using ChatGPT, and it would be like Web3 all over again. That seems to be not the case.
What about when Binance, Ajit? Can ChatGPT give us a when Binance?
I haven't tried that.
Well, given it,
maybe CZ will acquire it.
It actually thinks that my 13th century anonymous medieval poem paints a picture of humans as being destructive and disrespectful towards the natural world, and the birds serve as a metaphor for the innocent victims of human actions. This poem is also a call to action, urging humans to take responsibility for their actions and to show more respect for the environment. This is a 5-line 13th century medieval poem, and you're right. It's like dealing with a consultant. I mean, you can turn anything into a climate change activist, and I think we've just done that with ChatGPT.
Oh well. So I think AI is a big meme. ZK is a big meme. And then I think there's a lot of excitement around the Moo programming language and some of the smart contract platforms, and we've seen the Aptos. The 5xing of the Aptos price. Some say it's because of Binance. Binance double dipped into 2 successive rounds of Aptos. That's quite rare for Binance Ventures. And then Korea, right? Upbit had 40% of the volume, and Aptos had this hackathon going on in Korea. So there was a bit of excitement around that as well. So they're pretty good for the Aptos guys. I mean,
absolutely.
They do have the vibe. Which is quite interesting.
To be fair, they literally couldn't have launched at a worse time, right? Like between all that chaos going on with FTX in the market and a lot of those liquidations kicking off, it launched into like a bloody mess, right? So at least it's had some resurgence once things have come green, and we saw that also with the Optimism token, right? Hit an all-time high, and those like the new shiny toys kind of thing, Ajit, like they were the new shiny things that came in late to the cycle. So they're getting their attention now, and probably for fair reason, right? So they do have some market differentiations that sit aside from the other chains. So
It's still very early, right? I mean, this is year one for Aptos and Mistin and Fuel Labs, who are sort of building smart contract platforms or developer experiences that will directly compete with Ethereum and Cosmos. So they're looking to build safer, more object-oriented programming experiences, which might be a better fit for gamers. So that's kind of the promise. And Move came out of DM, the Facebook Libra project. So it's kind of some of the primitives they built in were supposed to make smart contracts easier and safer to write. Let's see how that matures, the whole dev tooling. So there is some excitement around that amongst a lot of VCs. So we saw a lot of famous VCs, A16Z, Jump, and so on. Temasek get into quite a few of these very large funds as well. But obviously, that has nothing to do with. I'm sure when the price was going 5x, people weren't necessarily thinking about the benefits of Move programming language, right? I think it was more a liquidity-driven rally, and as you said, it kind of Aptos launched into a bad market, and there is also low liquidity, but I think they were doing a Korea hackathon. And the folks in Korea, everyone I know, I think was pretty excited about that. So, and I don't think people remember that Korea has always contributed to some very big up moves in quite a few tokens, including Ethereum. So 2016, 17, I think our friends in Korea contributed quite a bit to the price jump in Ethereum. And Korea happens to be the land of degens. Do Kwon came out of Korea. Some of the riskiest plays come out of Korea. There was this TV series. What's the name of that TV series? About
the game, Squid Games.
Squid Games that came out of Korea. So there is something going on in Korea with like utter and complete degen vibes, and there's something to be said about that.
Sorry, there's only one. What's the greatest thing that ever came out of Korea, do you think, if you really, really had to think
Gangnam Style?
Exactly, right. Gangnam Style. Do you remember Psy was the guy, right? I think I'm trying to work out if that song is the one-hit wonder of the world, right? Or is that, or are we going to be the Chesney Hawks? The one and only could be the other one-hit wonder. Yeah, I think Gangnam Style is it, though, isn't it?
Yeah, I would love to have one of those hits against my name if I could get one. It's a bit sad to have only one hit, but then would rather have one. So there are quite a few blockchains that are one-hit wonders as well, especially from the ICO era. So hopefully the third generation blockchains will not end up there, and some of the L2s that are coming out now. I think Polygon will launch an L2, Arbitrum, Optimism. ZK Sync, Starkware, Scroll. There are quite a few L2s that are coming online. So we'll see how this, the L2 wars, are just starting, right? And so we'll see how the Arbitrum haven't launched a token, Starkware haven't launched a token, Polygon ZK EVM. There are people who complain about Polygon being not a true L2 but a sidechain. I think they will get their answer in Q1 with Polygon launching a true L2. So we had Alt L1 wars. Now we are going into Alt L2 wars. And, purely from a tech perspective and ecosystem perspective, these are going to be really exciting times. Whatever happens to the prices, I think the tech wars are always fascinating.
Ajit, like this compared to 2018, like 2023 is maybe our 2019. I guess like we've had a year of down-only markets. When I think back to that last cycle, the developer communities are so much richer now, right? Like the activity level is, because before, like in that last cycle, it was maybe it's not going to work kind of thing. Like maybe we don't have product market fit. But I think in this last cycle, although soaked with liquidity, I guess from a lot of economic stimulus, we saw a lot of product market fit in different verticals. Not only DeFi born from that down market, but we also, like the NFT market ran in this cycle and really brought in some Web 2 users into Web 3. They don't really care about finance, because, let's be honest, like the average person doesn't really care about DeFi. They don't care about finance. That's not where the value proposition sits for them. But the NFT community seemed to bring, obviously, a lot of people that had a wide range of interests from a wide range of communities they wanted to identify with. So what are your thoughts on that, mate?
Yeah, so I think NFTs. See, we are looking at. It's my personal view, right? So I believe we are looking at the financialization of everything on the internet, right? So whether it's culture, right, whether it's art or music or anything, right? So those anything can now become something you can own, and by extension, you can essentially sell or rent, which means you have a variety of property rights attached to a digital object, which wasn't possible before blockchain. So this is fundamental. It's phenomenal. I think people might have got a little bit too carried away by it, and in terms of how quickly things move, and that brought a lot of capital into blockchain. So pretty much every L1 or L2 has 300 plus million to spend, and that's way more money than I think we used to have in blockchains in total. Even at consensus, we didn't really have that kind of money. So I think all that capital has brought in a lot of talent, right? So a lot of money is also getting wasted, of course, right, on conferences, and I mean, no, there are some good conferences, and they're on parties, on yachts, and I mean, just straight up rugs and all that stuff. So there's a lot of grift and all that bathwater stuff. But there is also a lot of babies. So we're seeing much better talent come into the space, whether it's on the tech side. In fact, a lot of Web 2, the Google, Facebook, the FANG folks really FOMOed in because the tokens seemed like a sure sign, the fastest path to wealth. The ad industry, which is Web 2, wasn't really getting anywhere. So it brought a lot of talent on the business and commercial side, but it also brought a lot of talent on in terms of ZK research. I used to complain that we don't have enough PhDs in the space because we can't really get the kind of research Google guys were able to pull off. But now we have that sort of talent. We're seeing a lot of like Stanford PhDs and Cornell PhDs come into Web3, which is pretty phenomenal. And of course, there are lots of app devs, right? So now people complain about not having apps. But for the first time, we have DeFi. And DeFi is getting people really excited about tokenization, right? So I'm seeing private equity funds, I'm dealing with banks, and a lot of these yield generating asset owners who are essentially saying, look, before DeFi, which is last cycle, we tried to do this real world tokenization and securitization, but we didn't have anything, we couldn't do anything because what do? You issue a token, then what, right? Now it's possible to trade that token, it's possible to borrow against that token. So I think this is a pretty fundamental shift. And now you can use NFTs in some of the DeFi protocols. And the next generation might be gaming, right? I mean, internet has always been pushed forward by gamers. Gamers set the trend for internet culture. I mean, have since Tetris and Pac-Man, and Nintendo and God knows what else. So maybe, the next generation will be Web3 gaming. And yeah, sure, valuations have been crazy. A huge amount of money has been wasted in, on the play to earn thesis and God knows what else. But, it's not the failures that make the internet. It's really one or two successes that show people how things can be done. I mean, people used to complain about Google search, right? There is no business model. There is a search engine. There is no business model. It went on for years. And then suddenly Google has a business model. They surprise everyone with their earnings. So I think we will see some of these pretty cool things happen on Web3 as well. And Lens Protocol, Farcaster, people are starting to explore now things that are not necessarily focused on financialization. So we know that we can financialize everything on the internet, but now people are starting to explore use cases that do not focus on financialization, right? Like Vitalik's speech at ECC last year referred to. So hopefully, we might be looking at what Mark Andreessen talks about, but can't always give an example for that. This is really the next iteration of the internet, and it definitely is the next iteration of the internet culture, right? Everything my son does on Discord is happening on blockchain.
It's interesting you say Mark Andreessen. Obviously, he was one of the founders of Netscape back in the 90s and came out of NCAA Mosaic. One of the things that Mark said, which I think is probably the best way of summing up why Web3 and tokens or crypto is here to stay, is if you think about Web 1.0, right, it's an untrusted network. Web 2.0 kind of built on that untrusted network with kind of single sign-on social media, be it login as Google, login as your Facebook account, etc. But in both Web 1.0 and Web 2.0, we're still paying for things with credit cards, either manually writing them in or writing in our card numbers and entering our security code to get the transaction done, or using a PayPal. Everything becomes centralized around some kind of payment system. And the reason why that exists is because it's an untrusted network. But Web 3.0 is a trusted network. And with a trusted network comes all the financial services that you can then employ on a trusted network that you couldn't employ on Web 1.0 and Web 2.0. So that payment system, or the ability to move value around a trusted network, is the important factor for why crypto needs to exist. And to be fair, the writing is still on the wall as to whether or who wins the Web 3.0 kind of value system or value payments war. And maybe there'll be multiple payment systems because, like, we have multiple currencies. But the thing that I think people need to understand is that crypto is here to stay because you've got a trusted network, and in a trusted network, you need a zero knowledge, trustless payment system on a trusted network, and it's the only way that we can do that. And it's very interesting that people don't understand this concept because they haven't quite understood what Web 3.0 really does mean for the evolution of the internet. And I mean, we're starting our layer one for reasons that we don't believe have been solved in Web 3.0 yet. And Rhys, you might want, when we think about the problems we ran into in our DeFi portfolio and why we had to build a layer one, it just became, glaringly obvious that if we didn't do this, institutions wouldn't come, or if someone else didn't do it, institutions can't come. And Rhys, I mean, you've got a good experience of doing this, and we just found it didn't work, right?
Yeah, well, the current ecosystem isn't designed to be guarded by regulation. It's not designed to have safety rails, and that's the counterparty of, like, the true custody of having control of your own, being your own bank, right? That means you have to treat that capital with security that you're probably not used to, or manage risk you don't know how to understand. And that is normally abstracted out to a financial institution in real life, right, off chain. But when you take assets on chain, you have to absorb that responsibility. And when we talk to large institutions around the fund and how they're viewing this space, from some large funds we spoke to only a few weeks ago that everyone would know, the response is, we love the space, we know this is the direction, but we can't touch it. We can't deploy assets into a compound pool because we don't know the counterparties, and we have regulations and other restrictions on accessing that capital. When you don't know the counterparty, that really makes things very hard to manage from a risk perspective. And
so, I know it's that commingling problem.
Yeah,
right?
it's a commingling problem.
All of a sudden, you're commingled on chain with someone who's sanctioned, right? And then all of a sudden, if you think regulators fine you and they get to keep the money to fund their budget in some jurisdictions, if you're a bank using a compound pool and all of a sudden you're commingling with a Okta sanctioned address, what stops the regulator coming in and saying, "Oh, you're commingling with sanctioned addresses. Here's your fine. Thanks very much." The risk reward just isn't there.
Yeah, so I have an anecdote about this, right? So when I was working with Stanley building out AVR, so we went to Genesis and we were essentially doing a roadshow around crypto Wall Street, all the centralized institutions, and we spoke to the Genesis guys, and they were like, "Oh, who's the counterpart? Who are we signing a contract with? Are we signing a contract with the Aave companies?" And we're like, "No, the counterparty is the smart contract, which is a pool, right? This is where everyone deposits collateral and then they borrow against collateral." So they were like, "Oh wait, so no, we need a credit counterparty." But the funny part about this is they essentially swapped $1 billion in Bitcoin with against $1 billion of UST. So because sure they had a credit counterparty, but at the end of the day, the underlying, what was that counterparty really worth given the quality of the asset? So I think there are some, and meanwhile, while all of the centralized, crypto institutions a lot of the crypto institutions have collapsed. Aave, Uniswap, Aave, Compound, MakerDAO, these things are running strong and really have been almost a symbol of financial stability. By the way, on that note, we are the guys who built one of the few centralized products that stayed strong throughout this crisis. So Yield.app, I have to give a shout out to us for building something that has really done a great job of staying strong throughout this credit crisis we've seen.
Ajit, that's an interesting point you make around like the response that Genesis had on the counterparty, because it's a little bit of a misnomer, right? Because even though the pool is pooled assets, there's still provable ownership of who owns their share in the pool, and you could define like a million counterparties, right? To that how a liquidity pool works.
You can, but then but essentially, if there is a default, right? So how can compounder have a default? If let's say the smart contract gets exploited,
no, not the counterpart, not the contract itself,
you
but
have no recourse, right? So there is no one you can sue. Whereas if you sign a contract with Suzu, then you can potentially take Sue to court.
Yeah, no, absolutely, and I'm all for like the immutability side of the responsibility and ownership on the code. But if we look at like Tornado Cash, for example, if you deposit into Tornado Cash and those addresses are sanctioned, we know anyone that withdraws from those those addresses while the pool itself is a smart contract, the ones affiliated are the ones that are then impacted by their ability to transact with those assets, right?
Yeah, you can prove in Tornado Cash that your money was clean and it wasn't. Yeah, so you can essentially, you have traceability of funds.
Yes, you do. And you need to provide those proofs, right, if requested. And I know there's a number of like fairly well-known influencers in the space that have gone down this path with Coin Center, et cetera, around pursuing what it means to have to prove innocence yearly. I think is what they're requesting for this kind of thing. I know there's ongoing lawsuits and things. It's a very like interesting directive from OFAC that I don't think anyone really expected it to happen that quick or out of the blue, kind of. And I think that was an interesting moment for like what is because we get into the what is free speech kind of thing when it comes to that, and that's a can of worms. But as far as like an institutional level, that makes that look like poison, right? Like it makes that very difficult for them to touch. And I like that's the tech behind using proofs in Tornado Cash is fantastic tech. It's very cool, and some utility such as using payroll, like using ZKs for payroll to abstract away like what we take for granted in institutional, like traditional finance around anonymity, around the value of the assets you hold is something that tries to replicate, but unfortunately has other, like by default, the design of it has a lot of other use cases.
I think, so now we have come to the elephant in the room topic, right? So we spent some time talking about markets and macro and interest rates. But the big challenge, at least in the US this year, to the entire industry is going to be regulation, because the public perception of the industry, which was going quite swimmingly well with Tom Brady and Matt Damon, and even Sam was the darling of
and Larry David. We had Larry David. We had everything.
We had everybody, right? We had Reese Witherspoon. Every celebrity wanted to work in this industry. We were getting everyone from Google and Facebook that we wanted to hire, and now it's a slightly different environment. Now everyone's friend is calling and saying, "Why don't you maybe get a real job?" So I think the public perception of the industry was hit really hard by the SAM and FTX in particular, because they were so well known and popular, and the size of the debacle was global and about $8+ billion. So I think that's also brought. So Gary Gensler was meeting with Sam. Mr. Benham of CFTC was hanging out with Sam. So it's kind of brought a lot of egg on people's faces, and which puts a lot of pressure, like Laura Shin said, right? It's not that they're going to look after Sam. Sam has made them look really bad, and they're going to make an example out of him. But I think the bigger challenge is that there's a lot of pressure on people to in policy circles to do something, and that might be a bit of a knee-jerk reaction than anything else.
That's a good point, Lucas. Do you think the flow-on effect from that, and Gensler's obviously affiliation with Sam, and how the SEC looks in this, is going to lead to like an overcorrection in where this was going?
No, I don't. Gensler was, taught crypto and blockchain at MIT before he became the SEC chair. Right, he knows the product inside and out. Right, he's not stupid, right? The other thing a regulator's job is to look at the industry and make regulation that is helpful to the industry but protects its users, right? don't forget, another job of a regulator is to help in the formation of capital, right? And capital markets. And if, for example, you come out and over-regulate and you stop the formation of capital, then you are going against your mandate too. So I also think that the Sam Gensler meetings are a little bit overblown, right? I used to meet with the Bank of Japan board regularly when I ran cross-market trading at CS. I used to go and meet with them because we had such huge exposures to Japanese clients and the yen.
I was wondering who was responsible for those buybacks, Lucas.
Exactly.
You got the 10-year yields.
Exactly. And I mean, to sit with them and talk to them about all sorts of stuff. And, there's nothing nefarious or untoward that's gone on. They just need information. What's going on? What are you seeing in the markets? You're obviously a key crossroad in the market. You see a lot of flow. Tell us about what's going on. And then how do we think to protect and regulate our clients, right? Don't forget, FTX had an onshore business and an offshore business. And the onshore business, which was regulated and was under the scrutiny of US laws, was solvent, right? There was no problems with FTX US. The problem is fraud, right? It doesn't matter what you do to regulate. If someone wants to commit fraud or will try to commit fraud, the question is how do you stop them quick enough? And in what we found is that over the course of history, where there's a will, there's a way to conduct some nefarious activity on a large scale. And, we see it with the Adani mining thing at the moment. We see this everywhere. It doesn't matter what you touch, right? The question is as a user of these platforms, and I've always said that crypto exchanges are just private dark pools without a balance sheet. And because they have no balance sheet, the minute there's a problem, you're going to get rugged and they're just going to take the money from you. And that's always been our view at Yield App, right? Is that don't put your money with any exchange because it's not a bank, right? They're not sitting there on a guarantee. They are running at the behest of users whilst users have capital there. And the minute that capital gets pulled, the people who are last out are going to get rugged. And that's just the way it is. And if you look at the scale of the fraud that's happened at FTX and you think to yourself, okay, there wasn't just one person that knew about this. There's a whole bunch of people that must have known that assets that were not supposed to be commingled were being taken off the platform and used to go and punt in whatever area you want. And, maybe you thought, well, okay, if it works out, I'm going to be, the richest man in the world. Because don't forget, he's essentially levering other people's money, right? And that the outcome was the market turned and they just ran out of rope and they hung themselves. And, I think a bigger problem is the way it was done. I think the way Binance came out or CZ came out, called them out. And then I think the one that he did on Coinbase, should put him in prison. Why? Because Coinbase is a listed security on NASDAQ. You don't come out and make a statement that causes the market to crash or the stock to collapse because you've come out and said you don't have enough Bitcoin against GBTC or Grayscale. Cause the market to crash, and Brian Armstrong has to come out and correct it and say, well, actually, we've got over 1 million plus or whatever it was he came out with. But you shouldn't be allowed to say that. If I came out and said that in a bank and said, hey, these guys are doing X, Y, or Z, and I didn't have any proof of that whatsoever, and I caused a dislocation in that underlying asset, I'm going to be charged with securities market manipulation, right?
Yeah, well, we've seen this with Elon Musk and a few other billionaires, right, where people make forward-looking statements or statements in the market. And I think enforcement has generally been weak. And, we still have Mr. Josh Hawley essentially starting a Pelosi bill, which essentially will ban insider trading by Congress, by the members of the Congress and the Senate, right? So insider trading, there has been quite lax securities law enforcement against the powerful and the rich.
But hold on a second, right? Bitcoin and Ethereum are not securities, right? So they're not governed by securities law, right? But the ultimate thing is Coinbase is a security, and you can't come out and FUD a listed company, cause an event in a security, and then you should be able to get away with it. I have a real problem with that.
I think the Elon one is like from a few years ago when he said he had enough money to take it private, wasn't it? And it was like more of and that caused a huge pump.
Yeah, no, absolutely.
Yeah.
And I think this whole market manipulation piece, and going back to the regulation question, right? What regulators need to do is do what they've done well for decades, which is find the balance between allowing capital formation and growth and evolution of the products and protecting the users of those products. And that's a very
and
fine
protecting
balance.
innovation, right? And protecting innovation.
Of course. Innovation.
Right. But the only thing that FTX did, right, and if I'm really honest with you, this is the only benefit that FTX gave the industry was it gave the TradFi companies that have been working on their own chains, working on their own tokens, their own coins, their own platforms, time. And if I'm a traditional financial services institution, I would be absolutely stoked that a crypto native firm has destroyed the trust in the crypto native industry, and our trust is still in place. So if HSBC came out tomorrow and said, here's the HSBC crypto exchange, you can trade all your crypto through HSBC. We will custody it, we will manage it, we'll give you the liquidity, etc., right? You just open your account. There's no place for a Binance anymore. There's no place for an FTX anymore because the trust is there, right?
Yeah.
The trust is in that brand. And if you tell me that the minute Citibank turns on BTC trading on Velocity, if those of you don't know what Velocity is, it's the institutional grade FX platform. I'm not going to any other platform to trade my FX or my Bitcoin because it's so much better. And there's billions of dollars that have been spent on this. And don't forget, traditional financial services firms, especially the big one, can throw scale at this problem better than anyone else in the industry. And they've been doing it for years. I mean, HSBC has billions of dollars in digital assets in custody, right? Some of the meetings and calls that Rhys and I have had with some of the biggest wealth managers in the world, they look at what we've done and they go, yeah, we'd love to do that. But we've got regulatory capital controls that prevent us from doing it. But it's not hard for us to do it. Like, we've done the work. We can just turn it on when we're allowed to.
And they're very well aware of the ecosystem.
And FTX just undermined the whole industry. Yeah. And what did we see off the back of it? Well, market makers who had money on FTX have obviously had to make their spreads wider, and the market depth is now shallower. So that means volatility is higher and uncertainty is greater, which drives up people from the industry. Right? It's just, you look at some of these funds who weren't on FTX, but were with, like, say, a Falcon X or someone who were on FTX. Their claim isn't against FTX now, it's against Falcon X. The contagion and the problems in the industry are manifest, right? It's just so bad. And all of this was done because the trust in the ecosystem or the industry, especially crypto native, has been completely destroyed. And I don't know where you go from there.
Well, there is some good news for us, right? So there is a joke going around, and Henry Arslanian, who runs PwC's crypto practice and is a very popular speaker. We should get him on a show at some point.
Yeah, he doesn't do that anymore. He's now left that, and he is now running 9 Blocks Capital, which is a spin out from 9 Blocks.
Did he leave PwC?
Yeah, he's left PwC. He's now he's the co-founder of 9 Blocks, and that's a spin out from 9 Masks.
Good for him. I love Henry. So one of the things he said in one of his recent talks is that the era of kids running the industry is over. So I was like, okay, good. I'm not a kid anymore. I worked in compliance. Risk. I'm 46 years old. I worked on it with a bunch of traders. So good for all the older men and women. I mean, who have a little bit of experience in actual risk management, compliance, and all of that. Right?
Right?
The industry is
You're
going to
100%
scale
right.
and grow.
Right?
Then some
you're
of those
100% right. And I've got a lot of time for Henry. I know the fund. We've DD'd the fund. We're happy with what they've got, etc. No problem there. There's a great many things that we've got to look forward to going forwards, right? We've got a lot of things, and cleaning out all the bad actors and cleaning out all the shit in this industry is like the best thing that could ever happen to it, because there's some amazing tech. There's some very, very, very smart people writing some very, very innovative stuff. And it is accretive to the overall financial services industry globally, right? It allows people to be banked that otherwise couldn't be banked. It removes the reliance on centralization and monopolists in certain countries, especially in Africa and the Middle East. And it allows finance to be normalized across the world for anyone that wants to have the ability to own a wallet and transfer value, right? And I think that we've got those things covered. What's destroying the industry is that centralization on the back of, if we centralize, we've got more liquidity. And obviously the likes of, Uniswap, et cetera, are really trying to address that. And how do we create liquidity but still decentralize? And that's where we're headed, right?
Well, so that's the best part, right? So I think while money crypto was crumbling, we are almost coming to the end of the show. The tech crypto made massive progress, right? Across ZK, across some of the things Cosmos guys have done with Interchain, across Ethereum scaling, across NFTs and DeFi. They've just been in every ecosystem. There's been just phenomenal progress on the tech front. So maybe we really. So this year will probably be, while I think the society gets a handle on money crypto. How the institutions, the capital markets entities in this industry should be governed, and how they should manage their risk and conduct. I think the fact that we have so much talent coming in and so much innovation that's going on, so much research that's getting driven forward in this space, I think we're gonna have a phenomenal year in tech crypto, and that's probably I've never been this bullish on the technology in this industry as I am today, right? Even though I'm a little bit I'm fairly sad about the state of money crypto. I'm extremely excited about the state of tech crypto.
No, absolutely. I think that the innovation has really compounded and really accelerated in this space. There's a lot of lessons that I think we can take away from the past, not just last year, but the last few years. And, getting that semblance of normalcy back into the market and people focusing on the real value of the industry, which is, trustless payments on a secured network, right? That's what we want, right? That's the future of finance, and that's where we're headed. So yeah, I mean,
Yep. I don't think you can stop the internet. So whatever happens this year, the march of the internet will continue, because that's what the kids are working on, and that's what we need to be excited about.
Well, let's wrap up with some market thoughts, gentlemen. So we've seen a little bit of a pump the last few weeks across crypto markets. We had the rally in traditional markets a few weeks before. So is the question for both of you gentlemen, is the crypto market decorrelating, or is it just lagging traditional markets right now?
Some days it's leading, some days it's lagging. But I think it's, as more and more institutions come in, we will see correlations go up a bit across crypto and equities, and especially as it gets more regulated as well.
Okay, I think
I don't think it's
I think the biggest issue, right, is that people need to understand that crypto is now considered a risk asset, and it's a risk on asset and it's a risk off asset, right? So when markets look dicey, it's going to come off fast. When markets look, pretty, tepid, and it looks pretty, the risk looks pretty tepid, then we're going to see that rally. And what we're trying to see at the moment is, if I were to look at correlation across risk assets, I would say the correlation has shown to be extremely high. We saw it with the sell-off, and we saw it with the rally back. The only difference between these risk assets is these risk assets trade 24/7, and the moments of liquidity are finite, right? It's not fully liquid across that 24/7 cycle, 365, right? You have the weekend like we had where we saw that rally higher. People are interested in the level still, and people are interested in the direction it's traveling. But I think we need to see 30,000 breach, and then we'll start to see the basis pick up, and we'll see that funding sort of people start to lever into it, and then we start to see, do we get to 100K this year or not? Now, I have a very simple view that the macro backdrop is actually quite solid. We're seeing inflation come off. I think that the SEC, I don't think, wants to go too hard, because we need to see wage inflation start to catch up, right? Without the wage inflation that we need, you don't want to destroy the economy. You want to maintain that kind of momentum and positive sentiment. So, do we get, a one last hike at 50 basis points, or do we get like a smoother 225s or something? Or do we just start to see, we're going to wait and see? I mean, the market obviously is pricing in a hike, but, we've started to see that inflation numbers come down. We've seen Eurozone avoid recession today. There's a lot of positives coming into the market, right? And ultimately, that means you want to own risk assets. And the question is what's the right entry point? Was it the start of the year at 17,000 or just below 17,000? Or is that right entry point now? And maybe you get a bit of a pullback and it rallies higher. But it's still, it's early doors yet, I think. All right, guys, why don't we wrap this up? It's been a great show. Thanks, everyone, for your time. Ajit, Rhys, any final words?
That's great. Looking forward to doing more of these and getting some guests on. And I think we've got a really good blend of traditional experience and the most up-to-date happenings in DeFi and Web3. And I think we're going to make for some great shows.
Yeah, and we'll get some phenomenal guests. I think I have some really, we know everybody in this industry, right? So I think it's going to be really exciting.
Sounds great. See, thanks a lot, Ajit. Thanks, Rhys. Until next time.
Thank you so much.
Cheers.
Thanks, gents.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.